Hello, welcome to the next in our video series on IFRS Hot Topics. I'm Sandra Thompson. I lead our global technical team for financial instruments. I'm here today with Tony Debell. Many of you will know Tony. He leads our global technical team on revenue, liability and other issues. We're going to talk today about negative interest rates. Now why? There's no new standards on negative interest rates. However, it has become something of a hot topic due to economic environments which mean we are seeing more negative rates in certain parts of the world. And certainly we're seeing negative risk-free or near risk-free rates in places like Switzerland, parts of Europe, Scandinavia and Japan, but there are others. We hope to demonstrate in the next few minutes it does impact a number of areas of accounting. We're going to talk particularly about employee benefits, pensions, also financial instruments, some other standards that are impacted and touch on presentation. So Tony, could you kick us off? What about employee benefits?
Yeah, so employee benefits, IS 19, has some specific guidance around the discount rate that is used to measure employee benefit liabilities. The requirements of the standard are that you have to use the yield on high quality corporate bonds if there is a deep market in high quality corporate bonds in the currency of the obligation. If there is no deep market, then you use the yield on government bonds for the duration of the liability. Now that's a specific requirement. It means you have to use the observable yield on either high quality corporate bonds or government bonds. That means even if those yields are negative, they still have to be used. And as Sandra said, at the moment we are seeing, certainly for shorter and even some medium-term durations, the yields on high-quality corporate bonds and government bonds being negative. So the implications of that are that if there is a sort of a single short-term employee benefit liability and the yield is negative, then that would be used to measure the liability. When you're thinking about longer-term employee benefits, say pensions, then there's two techniques that are typically used to discount those obligations. The first is that some entities will use a weighted average discount rate, covering the term of the obligation. Now, in determining that weighted average, it's not possible to ignore some of the periods for which there is a negative yield. So the negative yields are taken into account in determining the overall weighted average. Another method that some entities will use would be to discount the cash flows in each period for the term of the obligation, using the spot on the yield curve to determine the rate for each of those periods. And in that case, again, if some of those spots on the yield curve are negative, which they may well be for the shorter durations, then that's the rate that has to be used. So IS 19 employee benefits has some specific guidance. If the yields are negative, those yields have to be used to measure the obligation. I think similar to IS 19, the financial instruments literature also has some specific guidance.
Yes. Yeah, thank you, Tony, it does. So I'm going to start off with classifying financial assets. These are holdings of things like loans and bonds. And when you think about are those assets measured at cost or fair value, one of the considerations is are the assets solely payments of principal and interest, or SPPI. Now, the standard does tell you what interest means in that context. It's compensation for the time value of money and credit and other lending risks. So you might question, well, if the amount is negative, does it meet that test? Is it compensation or is it going the wrong way? And the standard has some clear guidance that actually that can be a negative rate and you can still meet the SPPI test and therefore be at amortised cost. And essentially it sees a negative rate as potentially comprising a positive amount for time value of money and credit and other risks, and then if you like a fee paid that goes the other way, the negative fee, for holding money in a kind of custodial capacity, and you put those two together and get to the negative rate. So that's very helpful. The second area to think about in financial instruments, if you have assets at amortised cost or indeed at fair value OCI, then you need to do an expected credit loss, an ECL calculation, impairment calculation. And how do negative rates affect that calculation? Well, as the name suggests, an ECL is the expected loss the entity would incur if the borrower defaulted. And if you think about what happens on default, well, typically the amount it would expect to lose would be the unpaid principal plus any accrued but unpaid interest. So what if that interest is negative? It actually brings down the amount rather than adding to it. And I think there it depends. So if in that scenario the amounts are netted and the amount that would be claimed is the net of the principal less the interest, then yes, that will bring down the amount that can be claimed in a default and potentially give you a higher ECL. If they were settled gross, then you would have a different circumstance. And then the second thing to think about is the ECL is a discounted number. So having worked out that number, you then have to discount it using the original effective interest rate. And that too could be negative. It's the I bit of the SPPI tests. And if so, then that will give you a slightly smaller ECL. So both these need to be factored in. Then the final area with financial instruments will be hedge accounting. I can't talk about financial instruments without talking about hedge accounting. And it's quite common for both companies that issue variable rate debt, but also companies that invest or hold variable rate instruments to hedge those with interest rate swaps. Now, what happens when rate goes negative? And the answer here is really, well, it depends on both the terms of the variable rate loan instrument, debt instrument, and the terms of the swap, and they vary. So you could have a situation where for both the swap and the variable rate debt instrument, the rate can go negative. Now, in that circumstance, there's still a very good economic hedge. They perfectly still match in terms of the variable rates. So therefore, if all the other tests are met, you carry on with hedge accounting in the normal way. However, there are circumstances where one of the two instruments is floored at zero. So it might be that the rate on the hedged instrument, the loan, can go negative, but the rate on the interest rate swap cannot. The swap is floored at zero, so therefore you could never have a negative variable rate. In that circumstance, you clearly have a mismatch. That will at least give hedging effectiveness if it's short term, but it might mean that hedge accounting can't be applied at all. Then, of course, the third circumstance is where both are floored at zero. And in that circumstance, once you hit negative interest rates, actually there is no variable cash flows involved because they both fix at zero. So in that circumstance, you would certainly question whether you could have a hedge accounting because there is no variability in cash flows to be hedged. If it were a very temporary situation, then you might, but in longer term situations, you probably won't get hedge accounting. So that's financial instruments, but Tony, what about some other areas?
Yeah, so there are lots of other areas of the standards that require balances, assets or liabilities to be discounted, to be measured at present value. There is some guidance in probably all of those standards about the rate to be used, but they typically don't address with the same degree of detail as financial instruments and employee benefits the implications of negative rates. So the sorts of standards I'm thinking about, provisions, leases, share-based payments, significant financing component in a revenue transaction, they all need to be measured at present value, but there's nothing specific that addresses the implications of negative interest rates. So there's certainly a judgment for management. I think the first step in any of those situations in a very low negative interest rate environment is to consider whether the impact is going to be material. So relatively short-term balances, a bit like I said for employee benefits, the impact of using negative rates or whatever might not be significant. But if you move beyond that and decide that there is a need to do some accounting, then I think the first step is to consider the specific guidance in the standard. Because each of the standards says something specific about discount rates and interest rates, and so look at what it says. For example, if a standard requires the risk-free rate as a starting point that's then adjusted, then maybe adjusting the risk-free rate will mean that it is no longer negative. Maybe it won't. If the standard requires the risk-free rate and it is negative, then maybe that's the rate that you have to use. But the other angle that I think that might be considered when thinking about the implications of negative rates is something that Sandra mentioned earlier, which is the idea that a negative rate might be made up of compensation for time value and credit risk and something else, maybe a fee for looking after the depositor's money. And this was something that the Interpretations Committee also hinted about in an agenda decision that addressed presentation, where it said that, well, actually negative interest might be presented as an expense. Now that implies that there is something else in there, being the fee for looking after somebody's money. And so maybe that implies that in some circumstances, in other standards, that perhaps the interest rate that you might use gets floored at zero. So nothing specific in other standards. There might be more than one way of coming at the question. That'll make disclosure important, disclosing the impact, disclosing the policy that's been applied. So we've talked about the recognition and measurement implications of negative interest. I think that just leaves us to talk about presentation, which Sandra will do.
Yeah, thank you. I'm going to start with an entity like a bank or financial institution that actually reports interest revenue, interest income, probably is the top line of its income statement. Now, Tony, you helpfully mentioned that the Interpretations Committee was asked this question, and in particular, where that interest revenue is negative, can it be booked as revenue or does it go the wrong way? And the Interpretations Committee noted that the definition of revenue is in terms of inflows of benefits. Now, here you don't have an inflow, you have an outflow, so therefore it cannot be included as interest revenue. It doesn't qualify. The obvious next question is then, well, what could you do? And there are probably a number of things a bank or financial institution in that situation could do. So most banks would report interest revenue, interest expense coming down to net interest margin. You could certainly include it within net interest margin, either within interest expense or perhaps as a separate line item if it's material enough. You might also, as Tony hinted, report it as some kind of other expense. And similarly, a corporate looking at finance costs would have a similar judgment to make. Was it best subsumed within finance income, or perhaps as some other kind of expense, or perhaps within net finance cost? Which brings me back to another point that Tony made, that given there is a degree of judgment here, it will be very important when the amounts are material to disclose both the accounting policy and the amounts that are involved. So just to wrap up, I hope you found that useful. I hope we've illustrated why this is a hot topic given current economic conditions. We've talked you through the specific requirements as regards employee benefits and pensions, and also financial instruments, talked you through classification and measurement for other standards, and then touched on presentation. Thank you for listening, and I hope you'll join us next time. Goodbye.